Making this fine adjustment into your trading, especially when taking a trade, can double or triple your results, guys. And this is a simple tweak, but it actually can take you from a struggling to a consistently profitable trader. So this one trick will get you there, guys. If you've been going through FOMO feelings, or you have been going through years of losing, or just literally struggling as a trader, hopping from one strategy to another, this little trick will get you there. The reason being is because by employing this simple tactic in the beginning of your trades, you will actually eliminate the need of stressing out and eliminate the need of watching the charts for hours and hours in a row. So what is this trick, guys? And the best thing here, guys, is you don't even need large trading accounts. You can be trading on your micro account or a prop firm challenge. The best thing about this strategy is that it's very scalable. The best thing about this strategy is that we have very little to risk upfront because we are employing a risk-free model into the trading strategy. So let's have a look at how it works. It is crucially important to know that hedging is not done purposefully in this strategy. It is done because of a trading opportunity that has appeared itself, a revealed way to enter in a counter trade. So let's say, for instance, I would give you a real example, guys. Today I actually took a trade which was long Dow trade, and at the same time I took a short Nasdaq trade, which will illustrate this example in a very clear fashion. But before that, let me just give you a little bit of a theory. So let's say trade 1 is our Dow Jones trades, and this will be a buy or a long trade. Trade 2 is our Nasdaq trades, or this will be a short trade. In other words, those are two positively correlated instruments. In other words, when Dow is going up, Nasdaq is going up in most of the cases. There are, of course, the differences in the way they're going up or in the way they're going down. One is not precisely following the other, but I would say in good 80% of the time, this is what happens. And this is just one example of highly correlated instruments. So in this particular case, let's say I have found buying opportunity on Dow Jones. So this is our entry here, and this will be buying Dow. On the other hand, once we're in a trade here, let's assume the price is going up, we're making money. On the other hand, if we are seeing a short selling opportunity on Nasdaq, so this will be Nas sell, it means that if the price goes lower, and if let's say this is our entry, we would make money. At some point, this might divert. One of those, either Nasdaq or Dow Jones, might change course. If let's say Dow continues going higher, at some point Nas might reverse and stop us out. If let's say this is our stop loss, this is our stop loss here on Dow Jones. So we're gonna lose on one of the trades, which in this case is Nasdaq, and we're gonna make money on the other one. So I'm taking this one step further, and instead of just waiting plainly and vainly for the price to hit my stop loss, I'm enabling a risk-free mode, and this could be done only by having a very precise entry, meaning you need to have a rigorous system that finds high probability trades, and this should be during fast-moving markets. And also you need to have a system that helps you to get into risk-free trades very quickly. So with the case of the day trading strategy that I'm using, I can potentially enter in a risk-free trade in anywhere from, I would say, 13, even 15 seconds to maybe 3 minutes. So it takes me that long to enter in a risk-free trade. So let's say 15 seconds to maybe 3 minutes. That's roughly on historically how long it takes me to enter in a risk-free trade. And what does this mean is, if let's say we take the example of the Dow Jones trade, even though we're going to see the example in real time shortly, I'm looking to offload 50% of the trade at a break even. So this will be here, and I would be looking to do the same exact thing with the NAS trade. So I'll be looking to offload 50% of the trade here, enabling a risk-free mode. In other words, if the price reaches this level and then turns back, I'm selling 50% of my position and I'm running a break-even trade. If the price goes and hits my stop loss, I will not lose anything on this trade. In the case of Dow Jones, the same will be the possible outcome. If the price reverses and hits my stop loss after it has reached my first target, then again, I will not lose anything on this trade, since this will be a break-even trade. So now I think theory is great, but let's have a look at one very concrete example, and this happened today during the New York session. So I'm waiting for the price to get into this zone, guys, and I'm going to take a long trade here. This is literally in the first minute of the market open. I'm going to place my stop loss a few points below the market open. Just let's see where the price is going to print the low. This seems to be a good point, 380. I'm just gonna slightly readjust that and limit order now. Let's take a screenshot for the community, guys. All right, so we're running a risk-free trade already. I've taken half of the position, as you can see here. Let's take a screenshot for the community, and usually I can find another counter trade on Nasdaq, which is a correlated asset class. So here I'll be looking for potentially shorting after a few seconds. Let's just wait for the close of this minute candle. We're looking to enter in potentially a short trade. Let's see. Okay, that actually looks great. So I'm going to short here and place my stop loss just a few points above that. Let's just manage 72 here. I'm going to increase slightly, 77, and my limit order equidistant from the entries, readjusting the stop loss, and take a screenshot for the community, guys. Perfect. So now the Dow trade is miles away, as you can see, and the Nasdaq trade is already a risk-free trade. So I have literally nothing to worry about, since this is a perfectly hedged trade or a couple of trades. And this is a great way to actually keep all of your worries away and enter in trades and be perfectly hedged, even if you don't know the market direction, guys. This trade has paid wonderfully, guys. I'm gonna take profits here. It's 1:11 risk to reward ratio, and I'm closing the trade, as you can see. I'm gonna take a couple of screenshots for the community, but the other trade on Nasdaq was closed at break-evens, and this is one of the major things about using this type of approach, that one trade will always, get stopped out at break-even. The other one is gonna give you either multiple digits in return, or it will also get stopped out in break-even. But in the end of the day, it is basically you have the best edge in the world, because even if you get stopped out, it's a break-even trade.